the Indian stock market, a place where more than 7,000 companies are listed, where trillions of rupees are traded, and where millions of investors chase the same dream, making money. Yesterday, I day traded a stock. When the market closed at 3:30 p.m., the stock was trading at exactly 100 rupees. Simple, that's called the closing price. But here's something that confuses almost every beginner. The next morning, at exactly 9:15 a.m., the market opened. And that same stock, the one that closed at 100 rupees, opened at only 95 rupees. Wait, how is that possible? The market literally closed with the stock at 100, so why didn't it reopen at 100? Where did those 5 rupees disappear? This is what traders call a gap-down opening. And if a stock opens above yesterday's closing price, it's called a gap-up opening. But why does this actually happen? Let's find out. Imagine the stock I traded belongs to a company called Techie Tech Corporation. Yesterday, Techie Tech closed at 100 rupees. But here's the thing. Just because the market is closed doesn't mean the world stops. Overnight, oil prices can change. Global markets can rally or crash. The RBI can make an important announcement, the company can release its quarterly results, or breaking news about the company itself can appear. All of these events affect how investors feel before the next trading day begins. This is called market sentiment. But here's another question. Market sentiment is just people's emotions. So, how do emotions actually change a stock's price? The answer lies in something that many beginners don't even know exists: the pre-open session. Every trading day, before the market officially opens at 9:15 a.m., there is a 15-minute pre-open session, from 9 a.m. to 9:15 a.m. During this time, investors can place buy and sell orders. But here's the interesting part. No trades actually happen yet. Those 15 minutes are divided into 3 stages. The first stage, 9 a.m. to 9:08 a.m., this is called the order entry phase. During these 8 minutes, everyone places their orders. Someone says, I want to buy Infosys at 1,500. Someone else says, I want to sell TCS at 3,600. During this phase, orders can be placed, modified, or canceled, but nothing has been traded yet. The exchange is simply collecting everyone's orders. Then comes the second stage, 9:08 a.m. to 9:12 a.m., the order matching phase. Now everything gets locked. No new orders, no modifications, no cancellations. The exchange now looks at every single buy order and every single sell order. Its goal is simple: find one price where the maximum number of shares can be traded. Think of it like a mini auction. Thousands of buyers, thousands of sellers, one computer, trying to find the perfect opening price. The price where demand and supply match the best. That single price becomes the stock's opening price. Then comes the final stage, 9:12 a.m. to 9:15 a.m., the buffer phase. During these 3 minutes, the exchange verifies everything. It checks the calculations, confirms the matched orders, and prepares the market for live trading. Then, at exactly 9:15 a.m., the market opens. And boom! Techie Tech starts trading at 95 rupees. Not yesterday's 100. That's a gap-down opening. If the auction had selected 105 rupees instead, it would have been a gap-up opening. So the next time you see a stock opening much higher or much lower than yesterday's closing price, remember this. The closing price is history. The opening price is decided during the pre-open auction, where demand, supply, and investor sentiment all come together to decide the very first price of the trading day. And that's exactly why stocks gap up and gap down.